a moment. Just stay with us.
Yeah, thank you so much, Ladi. And of course, we start from the big news from yesterday. A divided Federal Reserve left interest rates unchanged on Wednesday as the U.S. Central Bank Chief Kevin Walsh pledged an unwavering commitment to bring inflation down, a message that has left markets confused about just what he was prepared to do. Well, of a total of 19 members yesterday, 3 committee members voted for a rate hike following the escalated tension in the Middle East, which is threatening energy prices. The meeting normally is made up of 7 members of the Board of Governors of the Federal Reserve System, 1 president of the Federal Reserve Bank of New York, who is a permanent voting member, and 4 of the remaining 11 Federal Reserve Bank presidents who serves 1-year rotating terms. Let's listen to Mr. Walsh first.
There is no soft inflation target. There is no soft implicit target, not on this committee's watch. There's only a target, and it's 2%. Not one of my FOMC colleagues is under any illusion. We've begun a new chapter, and we understand that the 5+ years of inflation above target cannot be cured in 9 weeks, or by a single month of modest price decreases. This Fed will not waver. Our credibility rests on performing our duties and delivering on our responsibilities. Americans are right to expect that because our nation's prosperity depends on it. To the regulars here in the press room, today's assessment might sound familiar, yet there was nothing inertial about our discussions, our policy, or our strategy. 2 economic developments are worth highlighting. The first is a very notable change since our last meeting 42 days ago. Nominal and real yields are materially higher across the Treasury curve. In fact, some of the increases in market interest rates between FOMC meetings are among the most significant in the last 2 decades.
And of course, when the U.S. sneezes, the whole world feels it. Let's get reactions from around the world. Beginning from the United Kingdom, we have Juliana Olayinka, our London bureau chief, joining us to get reactions that have followed this hold decision. Hi, Juliana. Good morning. So the markets and from not just the United States, majorly expected a hold position. I wonder if this has brought any shaking or movement around investors or the market in the UK.
Good morning, Innie. I suppose here in the UK we're waiting for the Bank of England's interest rate decision at noon today, and I think pretty much broadly the assessment is that rates are going to hold at the same rate we saw held last night in the US, which is about 3.75%. I think the major issue, as we just heard from the central bank governor there in the US, is of course the uncertainty around the war in the Middle East. I think by now a lot of investors had expected at least there to be some sort of cessation of hostilities, particularly around the Strait of Hormuz, where we know so much of the world's energy is centered. And I think it's because of that uncertainty that central bank governors are still a bit nervous. So I think pretty much broadly, the decision yesterday was expected. As you pointed out, I think what perhaps took some economists by surprise was the dissent. We had 3 notable voices from the US Central Bank deciding to vote against the majority. So I think the 3 decided that they believe that inflation perhaps is getting out of hand and they should try and combat that as quickly as possible by bringing down rates. So that was quite interesting, the fact that we had 3 disagree with the overall decision. I don't think this has happened in well over, gosh, I think it's been almost a year since we haven't had a unanimous decision out of the US central bank. So that was quite telling. I think also what was quite telling is that borrowing costs reacted as soon as we heard from the central bank governor. So they immediately rose, and this is long-term borrowing costs. So I think that goes to show that, of course, the main signal does come from the central bank. However, markets will react on their own. So we did see US borrowing costs hike anyway, despite the fact that rates were held at 3.5%.
And it makes me wonder if perhaps we could be expecting some differentials in opinion as the Bank of England meets today. Because, I mean, the one from the US was obviously not expected. We thought it to be everybody agreeing for a hold. So I wonder if you've heard some tips about decepting voices about the meeting today.
Well, during the last Monetary Policy Committee gathering, I believe there were two deputy governors who decided to, who wanted to hike rates. Rates were held. I think in the UK, you're more likely to get a vote that isn't unanimous. Again, I think we're expecting rates to be held at 3.5%. We heard Walsh there going on about the benchmark rate at 2%, which is exactly the same as here in the UK. I think inflation at the moment is about 2.6%. It's not as high as there have been some estimates, but again, when we look at inflation, we're typically looking in a rearview mirror. We're not seeing what the costs are on the everyday household, but you know, and they're still going to go much higher. So we're expecting, I believe at the last MPC gathering, the Bank of England Governor Andrew Bailey said that inflation may get to 3.25% before the end of the year. So I think all eyes, of course, here in London are going to be on Threadneedle Street at lunchtime, where rates are expected to be held. However, I think the minutes that are going to be mentioned after the meeting is going to be particularly important.
Yeah, we'll certainly follow up on that. So, I mean, one of the main causes of all of this uncertainty and hold is obviously the war going on in the Middle East. But it does seem like a company like Shell, they are recording profit based on that. Yesterday, they declared record profit, about double, and they say this obviously is connected to the Middle East. But there's also the call for windfall tax. I wonder what you're hearing about this.
Yeah, that's absolutely right, and it's quite typical when we see these significant wars, as we saw in Ukraine when it began over 4 years ago now, that the biggest winners, if you can call them that, you know, from these conflicts are the big oil and gas companies. And once again, Shell have reported extraordinary results. I believe in their last quarter, you know, earnings reached nearly $10 billion US, and that comes at a time where many citizens from across the world are still struggling with energy bills. Energy price caps continue to be tight. It was only a couple of days ago that the new Prime Minister here in the UK, Andy Byrne, said there is going to be some sort of a cut on the VAT on electricity. Now, as governments are trying to, you know, save every penny and every pound, you've got these gas companies recording extraordinary profits, and they are also, you know, providing dividends for shareholders. And so, of course, that's not gone down well. That's always a geopolitical issue. You know, some would say that Shell, BP, and the like are not doing anything wrong. They're just, you know, participating in their normal business as standard. But of course, when war brings so much misery, so much crisis, and so much cost to the everyday individual, I think activists believe it's only right for governments of the day to step in and, you know, put out some sort of windfall tax, which is what we are expecting. And so I'm sure shortly we'll probably be hearing from the EU or indeed domestic governments about what they intend to do about these extraordinary profits that have come from so much misery.
Well, have you had any reaction from the companies, you know, the ones who are going to pay this tax?
I I haven't heard from what Shell or BP have to say. I believe, as I said, that they typically put out a blanket statement that, they are conducting their ordinary business.
All right, thank you so much, Julian Olainka, London Bureau Chief, for giving us updates on those issues.
Thank you, Annie.
And still staying on the whole decision of the FOMC yesterday, our Washington correspondent Maria Bed had a chat with an economist, Jeffrey Degner, and shared this with us on what he has to say about that position of the Reserve meeting.
Mr. Warsh has committed to is to making the Fed's footprint a little bit smaller in the broader economy. Now, he has also stated that price stability is one of the key goals. 30-year.
The U.S. stock market took a major dip on Wednesday as the Dow Jones led the day with the greatest losses at 2.2% down, and the S&P 500 was also down at 1.5%, and the heavy-tech Nasdaq was also down at 1.7% as chipmaker stocks continued to sell off, as it's also clear that there was a major downward take in the tech industry, as also the Federal Reserve Chairman's announcement today that there would not be any rate changes caused some concern for many investors, as there was an uptick in the yield bonds, but there was not any upward tick in the U.S. stock market. But we also did see some oil prices increases, also due to the fact of the U.S.-Iran conflict. This has continued to have an impact on the U.S. economy.
Well, we do apologize for that mix-up there. So that was Maria Bird giving us the close of markets yesterday after the decision. But we'll go back to the economist who was reacting to the decision and even told us as much as what may happen to the balance sheet of the United States following this stance. And of course, forward guidance shared after the meeting. He put all of that together after this interview, after the interview that Maria Bird had with him. Just a bit of it for you.
Well, I think one of the things that Mr. Warsh has committed to is to making the Fed's footprint a little bit smaller in the broader economy. Now, he has also stated that price stability is one of the key goals of his leadership. And in part, what we saw today is that long-term treasuries, the 10-year and the 30-year, might be doing a little bit of that heavy lifting for him, especially because, for example, the 10 and 30-year, those rates tend to influence things like mortgage rates, and with higher rates in that area, we might see some downward pressure in housing prices here in the U.S. So in a sense, he's been able to take a little more of a laissez-faire position here and allow markets to do that disinflationary work. But of course, that's going to take some time. And the disinflation that I think that he's aiming at is still being complicated by the energy sector and what we're seeing happen with continued volleys between the U.S. military and Iran as those energy sectors continue to be elevated in prices. And so that, of course, is sort of the top layer of the price inflation we're seeing right now. But again, I think Mr. Warsh is also going to be paying attention, as he said he would, to the overall size of the balance sheet. Still about $6 trillion left in the Fed's balance sheet when it comes to securities, and about $2 trillion in mortgage-backed securities. And so I think that we can, again, keep our eye on his decision-making there, as there are a few task forces that he's developed to work on that issue, as well as maybe looking at the measurements of inflation. So I think we saw more of a hawkish sort of stance that some people anticipated and maybe coming to fruition here with his leadership.
Well, there's still a whole lot for the United States to handle. And of course, it spills over to other parts of the world, including Nigeria, whatever decision the U.S. makes. And with this escalating tension in the Middle East, that's obviously is a problem for us all. But away from what's going on in the United States, now the Reserve Bank of India, they've sold about $7 billion in the foreign exchange markets to support the rupee amid increased pressure on the currency. And the intervention is aimed at curbing excessive volatility and stabilizing the rupee as demand for the US dollar strengthened. And market analysts say that the move underscores the central bank's commitment to maintaining orderly currency market while safeguarding financial stability. And Toyota Motors worldwide sales in June rose marginally from a year earlier, and this marks the first year-on-year increase in 5 months. As robust demand in Japan and North America offset continued weakness in China. The world's largest automaker sold 886,454 Toyota and Lexus vehicles globally. That's up 0.1% from a year earlier. And this data is from the company itself. Then Samsung Electronics has clocked a stronger than expected second quarter profit as the memory chip maker benefited from outsized artificial intelligence fueled demand. Shares of the world's biggest memory chip maker swung widely on Thursday, rising as much as 7% before sharply curbing gains to trade flat. This comes amid broader volatility in South Korea market, with the Kospi also logging wild swings. Those are the foreign stories for this time. I'm Ini John Mekwa.